Hello, it's the time to present you with the 5 biggest positions in my UK portfolio. We have done already some educational videos, but this time we will specifically talk about some companies. Again, the objective of the video is not for you to blindly copy what I do, but to take some ideas and understand the process. It won't be a very detailed analysis of the companies. It will be just an outline of how and why I pick these specific stocks. So let's start. The first one is the BT Group. The BT Group is the largest position in my ISA account, the largest telecommunication provider in the United Kingdom. What I like here is the stability of the results. The net income is about 2 billion per year. Now this year, because of the situation, is lower, but through the years stable, a well-established company. And then the valuation right now, with the stock trading at around 130p, the market capitalization is under 13 billion, which is amazing. It's much less than 10 times the earnings. So that gives a yield of more than 10%, which is very rare to find in today's world. And when we know that this company has stable earnings, this seems to be fantastic. Now, the problem here is that the BT Group has a quite large net debt, which is lower than what we see here in TCAR. It's around 11 billion because we have lease liabilities. This is high debt, but because the profitability is stable, I don't find it so dangerous. However, the company, because of the situation, has suspended the dividend. This is one of the reasons that the stock trades at a so low valuation. Now, I have 3 factors that I take into account for deciding how large my position will be. And that explains why the BT Group is the largest position in my ISA account. The first one is about undervaluation. And I think that the BT Group is really undervalued. Then the second factor is how defensive the investment is. I have a range of outcomes, and I think that it's very rare for the BT Group to be worth less than its market capitalization. So, in that sense, I believe it's a defensive investment. The third factor is how familiar the business is. For BT Group, we know the product as consumers. We don't know a lot about the technology, but we have some knowledge as consumers. We can understand the product as consumers. The BT Group satisfies all 3 criteria, and that's why it is the largest position in my portfolio. The next one is Zytronic. Zytronic develops and manufactures touch sensor products that sells in different industries. It's a business with historically high margins. That's what I like, businesses with high margins. It's difficult to turn into losses. We see there was a period of rapid growth that then slowed down, and now we see that during this period we have some deterioration which won't last. There are some industries that they get affected and that affects Zytronic, but I don't think that that will persist in the long term. So that's what I like here. We have losses that probably in the future would turn back to earnings. Something very important, the company has a lot of cash. We see that the net debt is negative. That means that it has net cash of 14 million. So with some losses, it's very difficult for this company to go bankrupt. So that means that it's safe. And then if we go and see the valuation right now, the market cap is a bit more than 20 million. So when you have 14 million of net cash and then this business trading just for 22 million, of course you can see how cheap the stock is. Why Zytronic is a large part of my portfolio, the second largest position. First of all, it's very undervalued and the upside potential is huge. It's very undervalued, and also we can't see that because now the earnings are not present. But when we we have earnings, this will be obvious. So we can buy the stock for cheap now that it's not so obvious. The catalyst is the plans of the company to use this cash to buy back its shares. I won't say more about this. So the first factor is that the company is very undervalued. It has a lot of upside potential. It's defensive again because of the cash. The problem here is that I don't have great familiarity with this sector. What I can see is the good margins that this specific business has, and I hope that we won't have like a technological disruption or something that could change this. But yeah, I'm not very familiar with this specific industry, but I like the profile. Low valuation, great turnaround prospects, too much cash. The next one is Greydons. The company offers hair care, skincare, different types of products. What's interesting about this company is the growth that they have achieved through the previous few years. They have almost managed to quadruple their revenue, and also we see the improvement in the earnings, and probably the economies of scale help this. The amazing thing is that this hasn't been reflected to the stock. The revenue has grown very much. Of course, the stock has gone up a bit, but it hasn't fully reflected this growth. So right now the company trades at around 10 times earnings, which seems amazing for a growth firm. Now, also this business is able to produce those earnings with very little capital, and that's how we see that it has a very good return on capital. So it's a capital light business, and this increases the possibilities that they can continue growing in the future. If that's the case, this stock can be a multi-bagger because we buy growth stock for about 10 times earnings. Of course, there are some problems with capital light businesses. They are not assets that can back the value if things go wrong. But here the valuation is very low, so at least we don't overpay. If the company doesn't grow and they just can keep the earnings, again it will do well. Also, I like the management in this company. I have seen some of their video and they seem grounded. I like how they are. So is this stock an undervalued stock? It is very undervalued because such a company can become a multi-bagger. So in that sense, it's undervalued because there is a possibility they can rapidly increase their earnings. So if they double their earnings in the next 5 years, it will be amazing for us as shareholders. So yes, it's undervalued. I would say that there is some risk here because it's a capital light business, so that's why I don't find it so defensive like Zytronic or the BT Group. And then I don't have great familiarity with those products. I don't use them. I can just see the history of the numbers, and I see that my assumption says that the range of fair value is much higher of the current price. And the great thing here is that, I mean, the BT Group is very undervalued, but there won't be a 4-bagger, 5-bagger, but this company can be a 5-bagger or something like this. The next one is MS International. MS International designs and manufactures engineering products. It's a cyclical business. We can clearly see that. We can see how they fluctuate through the years, and the company for some years will have great earnings and then some lower earnings and then again great earnings, and now through this difficult period they have losses. So it's a cyclical business. What I like in cyclical businesses is that you have those bad periods and they will turn back to good periods. Again, the valuation is very low. We saw earnings of 2 to 5 million earlier. Now the stock has gone up lately, but it used to be as low as 19, 20 million. And as in Ztronic, the fantastic thing, huge net cash position, again 13 million. So when you were buying at this super low valuation, actually half of the price is backed by the cash that sits inside the company. Yes, it's super cheap, and if we have again good periods and we have some great earnings, we buy this firm for just 25 million, which is very low. Now, another thing that I like the letters of the chairman, who seems to be very authentic and grounded. So, is this business undervalued? I think it's really undervalued. Again, here the range of value. I mean, if they return back to earnings, the stock again could see much higher prices. Then I think that the risk is normal. We have the cash, but because it's cyclical and also it's a small company, and when you have cyclicals, sometimes the bad conditions might persist for longer, and you can burn some cash. So I would say again the risk here is normal. And then I don't have great familiarity for this business, but they are the two other factors that attract me to this stock. The last one is Central Asia Metals. Central Asia Metals is a miner. They produce copper, zinc, and lead. They have two mines in Kazakhstan and North Macedonia. Central Asia Metals was not a large position in my portfolio when I initially bought it, but then the stock went up, so now it has become a large position in my portfolio. What I like in this company is that they are a low-cost producer. During this year, the conditions were a bit depressed. So I think that even in bad conditions, the company can produce this amount of earnings, around 40 million per year. And if conditions can go better, they can produce even more. And when you can buy them for less than that, I have bought this company much lower. Now I don't sell at this price, but I think I'm ready to sell. It's a cyclical business, so you buy when the conditions are bad. If in the future they have favorable earnings like 60 or 70 million, even with 10 times earning for 700 million, I would sell this company. Another thing that I like is that when you have miners, very often they manipulate their results. Here we see that they produce cash flows and they distribute a high proportion as dividends to the shareholders. And the other thing is that they are not heavy in debt. So when you have the low cost producer and you buy them in depressed conditions and they don't have a lot of debt, this is a good thing to do. So is this stock undervalued? Yes, I think it's undervalued. Is it aggressive? I wouldn't say it's very aggressive, but because it's cyclical, I would say it's normal, not too aggressive, not too defensive. Am I familiar with the business? No, I'm not familiar with the business, but I can understand the concept of buying the low cost producer with low debt, buy them at those depressed conditions at low prices, and then sell them when the conditions are getting better. And it's difficult to lose money that way. So I know the concept here, and it's not that I'm very familiar with this specific business. Something that can act as a catalyst is that the price of some metals now is going up, especially for the copper. If those conditions continue, yeah, we could see greater earnings and prices for the stock, and there I would be a seller. For buying UK stocks, as a UK resident, I have an ISA account and I own these stocks in my ISA account. For long-term investors, I think it's the best option. But if you are outside the UK, you can buy these stocks through Interactive Brokers. I have the link in the description below. I have widely used TCAR to show you some fundamentals, but if you're about to invest, you should always go to the actual documents, the annual reports, the announcement, and see the actual information in much more detail. But I find TCAR a very useful tool. It's for free. Those are my largest positions in the UK. Take the ideas, but please don't copy me. Do your own research. I hope you enjoyed the video and found it useful. In this case, hit the subscribe and the like button.